welcome back to another episode of the Recession Resistant Real Estate Radio. I'm your host, Brandon Cobb, and on today's episode, I've got Victor. How do you pronounce your last name? I want to make sure that I don't butcher this and I get it right.
Sure, it's Victor Menasce.
Victor Menasce. Victor's the senior partner with Y Street Capital. He's host of the Daily Real Estate Espresso podcast. Highly recommend that podcast. He's the author of the book Magnetic Capital, and Victor is a sought-after speaker for conferences, radio, TV, and podcasts. He's involved in a plethora of real estate niches, including land development, new construction apartments, senior housing, storage. Victor, welcome to the show. It's great to have you.
Great to be here.
Yeah. So let's jump in, give the audience an idea of what you're focused on, right now, and maybe give us a little bit of background about how you got here and chose what you're doing today.
Sure. It's been quite an interesting journey. I won't go too far back, but I got my start in my career as an electrical engineer, and not the typical career path into the world of real estate investing. Started out designing microprocessors in telecom applications, and then ultimately hundreds of different weird and wonderful applications all over the world. Everything from, I've got a chip in the Patriot missile, to seat back displays on Airbus aircraft, Hewlett-Packard storage networks, pachinko patchy slot machines in Japan, cellular base stations. The list goes on and on. It was a lot of fun. And about 2009, I was on my 18th trip to Tokyo in a year and a half. It was burning me out physically. That 12-hour time zone shift every couple of, every week was a little bit punishing on the body. It just wasn't the right thing for me and for my family. So I resigned my vice president of engineering role and took a hard left turn into the world of real estate investing. And there was something kind of magical happening around that time, 2009. It was a good time to be playing offense in the world of real estate. Not a great time to be playing defense, but it was a great time to play offense. And it was hard to make mistakes, made plenty, but the marketplace managed to wallpaper over most of those mistakes so that I'm still here standing and doing bigger and better things. So today we are involved in, like you said, land development, multifamily apartments, primarily new construction, senior housing, storage. We're in multiple markets across both the United States and Canada. And of course, the current market conditions have made some of those projects a lot more difficult to execute right now.
Mm-hmm. Yeah. Now, interest rates have coming up, especially if you were looking at doing kind of build to rent products. It might not pencil like it used to. When you were looking at getting into land development, new construction, for a lot of investors, this seems to be a risky investment for some reason. I think a lot of people still might have a bad taste in their mouth from 2008 and 2009 from a lot of the people that went belly up in this, but I personally think, because we're involved in it, that it is a great way to actually mitigate a lot of risk, especially if you can control that. Speak to a little bit about, why you chose to get into the new construction space as opposed to buying existing, value add, et cetera.
Well, we kind of backed into it in a new evolutionary way. We started acquiring really distressed properties in the inner city in Philadelphia. This was really at the bottom of the downturn, 2010, 11, and 12. And these were highly distressed properties. Some of them we were able to salvage. We demolished the inside of the buildings and put a new building on the inside, but managed to keep many of those historic structures. And that worked out. So then we said, well, for the ones that we couldn't salvage, why don't we just build new in a context of an infill? So the step from heavy reno to new construction was a small step. Mm-hmm. And then we said, well, we've got some of these properties. If we could get a little bit of extra density with a zoning variance, that would really make the numbers work. So we started doing some zoning variance work, and that was a small step. Then we started doing land assemblies, and, step by step, every project we took on something new. So from there to doing greenfield development, where we're entitling larger parcels of land, site plan approvals, getting zoning changed, was an incremental step. Oftentimes, if you think about the wake of the great financial crisis, we saw property values fall, obviously, on finished product, but the demand for land, the bottom fell out of the market completely. It went from being in demand to not in demand. Like there was just no demand for land at all for quite a long time. Why would we focus on new construction? Well, it's because we went through a period of 5 years where there was almost no new construction in the marketplace. So there was a lot of pent up demand.
Mhm.
And if we could fulfill that demand, we saw an opportunity. And then, of course, the market became much more heated, became an auction environment. People were paying too much. And we said, well, there's no one competing for an idea that's in your head. You're alone with that. So if you see a piece of dirt and you could see what can be done on it, there's no one else like that. If it shows up on the MLS, there's no flashing red light on it saying, come get me, I'm a deal. You've got to figure out, you're not finding a deal. You're creating it out of thin air,
Mhm.
out of a concept that's in your head. And we found that to be more powerful. So that's really how we got into it. Today, we still love development very much. It's the opportunity to create things that are compelling for people to call home,
Mhm.
and I think it's also the opportunity to do things that span economic cycles. So, for example, if you're looking at a project that is strictly, on a 6 or 12 month horizon, and with everything that's happened in the last 9 months,
Mhm.
you might be scratching your head, going, "My gosh, how do I make this work now?" But if you are planning a project that is a 5 or a 10 or a 15-year project that clearly spans economic cycles, you kind of don't care what's happening right now in the marketplace. It's really not affecting you because a project of that length is going to have an economic cycle or two in the middle of there
Mhm.
anyway. You have to plan for that. So that's how we look at it.
And when it comes to doing new construction, what steps are you taking to mitigate some of the risks and create, people talk about buying existing value add. One of the things that I really love about new construction is you can basically create the value on the front end if you do a rezone process, right? I mean, it
Correct.
gives you a
Yeah.
lot of leverage when you can offer the seller a lot more money for your house. Speak to a little bit about how are you mitigating some of the risks with new construction? We've had a lot of volatile turn up, interest rates have come up. What are you guys feeling and what steps are you taking?
Well, from a land perspective, when you buy land, land doesn't cash flow unless you turn it into a parking lot or something. So you have to be much more prudent with your cash. It means maybe buying with 100% equity and not putting any debt on the land. Or if you do put debt, you do it conservatively so that if things take longer, as they often do, you're not going to be caught in a difficult situation. And that isn't to say we haven't used debt. We have sometimes, and sometimes we regret it. But so we really aim to fund with equity. A simple case in point, we just completed the acquisition of a very large acreage, 1,783 acres, purchased all cash.
Mhm.
And the plan there is obviously to add value to the property, get it zoned, and build a master plan community. So we're going to get a big multiplier on the value of the land, taking something that is essentially a ranch and turning it into an extension of the city.
Mhm. How are you guys structuring your current deals? Because I know you're building all over the place, right? I don't think you're just in one little pocket. And some of the biggest risks is buying a piece of land that maybe has some issues with it, right? If you don't take it all the way through the entitlement process, or if you don't have a good local partner who can take it through that entitlement process and understands that. Otherwise, you're kind of just stuck putting things under contract and either trying to entitle it yourself, which, good luck doing that if you don't live in that city, because every city and municipality is different. How are y'all, finding people to do that or creating those relationships?
Great question. So if you truly understand the development process from a management standpoint, whether you're developing in Boise, Idaho, Toronto, Canada, the processes are very much the same. They're
Mhm.
very similar. Rules will differ slightly, but they're very much the same. You spoke a little bit to the local politics, and that is important to hire local people that have those connections so that if you need an audience with the mayor, they'll actually answer your call and all of those sorts of things. That's important. In terms of actually understanding the process, that's usually not such a big deal. If you really understand how development works, most cities follow very similar steps. The issues are kind of all the same. So that doesn't really make a huge difference. but the local component is absolutely important. Absolutely important. We always make sure that we have some folks locally that are on our team, whether they're part of our core organization or whether we hire them as consultants, one or the other, we'll make sure that we have that.
Okay. So, and y'all probably got a pretty strenuous process for vetting these people and making sure that they got the know-how, probably very similar with your builder partners that you do, because I'm assuming you're vetting and hiring a local builder. What does that process look like? I mean, that's a lot to be able to invest in a city that you don't live in, and you're trusting somebody else to actually execute on the project. I mean, walk us through your process. How are you vetting these guys to protect you and your investors?
That's a great question. The first thing we do, the first thing to remember is that what we're aiming to do here is all institutional quality. So if you think about the spectrum of builders, you've got two guys in a pickup truck at one end of the spectrum.
Mhm.
And then you've got the large national players like Swinnerton and PCL that, literally have thousands and thousands of employees that can take on big, big projects. Those folks tend to be pretty honest because they have to be. They have strong systems, strong checks and balances. And then there's a tier in the middle. And if your projects are not huge and you're dealing with a builder that might do, I don't know, 500-600 million a year in new construction, those will be also good quality builders as well.
Mhm.
We tend to stay away from the two guys in a pickup truck. That's where you run into the most trouble. So it's that medium tier, that upper tier builders, we find very good results with. And so we tend to stick to those. Some will argue that they're a little bit more expensive, and they can be,
Mhm.
but oftentimes these larger builders are often looking for gap filler projects. So, they may have a big project that might be, a few 100 million and it gets delayed. Now, all of a sudden, they've got people that they need to put to work on a gap filler project. And sometimes we can be that gap filler project. It's only, it might be 200 units or something like that. That might be an ideal gap filler project for a company like that.
I love what you said there. A plus players are attracted to A plus opportunities.
Oh, yeah.
All of the headache that I hear when it comes to the contractor world, it's all mom and pop stuff because the A plus players are not attracted to those C and D opportunities. If you're focusing and really thinking big and you're going after, like what you said, the institutional style stuff, you're going to attract that A plus builder. Now, when you're working with these builders, we've had this, the past 2 years with COVID and everything, we've seen crazy run-ups in construction costs, and the same pressures that were causing home prices to increase and causing asset values to increase, the supply chain issues, the lack of supply, the drawn out build time frames, all of that caused a gap where it pushed into some of that profit, and you would have normally seen that recaptured when you sell it or hold it, refinance it, but you're not now because you've had this run up in interest rates. What has the situation been with your builders? What do those agreements look like? Have they just eaten these costs, or are you seeing them come back to you and say, hey, look, I've had some run-ups here, we need to renegotiate on the price, and how are you dealing with that?
First thing we do, and this is not necessarily easy to do, is we pre-purchase materials. So we, even if we are getting things long before we need them, we make sure that we have price stability. We'll pre-purchase and warehouse materials so that we have certainty. And that can sometimes be a difficult discussion with the lender because the lender, if you're familiar with the way construction draws work,
Mhm.
they want to secure their loan. And the only way they can secure the loan is if it's part of the building. So a pile of 2x4 sitting on the sidewalk is not part of their security because it's not part of the building yet. Those 2x4s need to be installed. They have to call the inspector and say, yeah, those are installed now in the building, and the bank will now give you a reimbursement for having spent that money because it's now part of the asset. It's a little bit more difficult discussion if you're saying, okay, we're going to buy all this material and we're going to warehouse it. So the bank obviously needs to lien it, or the GC needs to warehouse it and fund it out of a line of credit. The question is, who's going to carry that inventory? That's really what
Right.
it comes down to. So, if you're if interest rates are relatively low, let's say well, let's just pick a middle of the road number. Let's say you're paying 5% for that money. And I'm just making this up as we
Mhm.
go here. But let's say you're paying 5% for that money. And let's say that you have more than 5% risk on your prices over the next 12 months. That feels like a good bet to me,
Mhm.
to warehouse that material and pay the interest cost. That just feels like a really good bet. If you just look, for example, at the price of insulation, I remember buying, I'm seeing just insane prices, like almost double what insulation was a year ago. So you want to be able to mitigate some of those risks, and we do it by pre-purchasing. That's probably the number one tactic. This no different than Southwest Airline hedging their fuel costs, making sure that they've got long-term supply contracts. Same kind of thing. You got to be thinking a couple of moves ahead.
Yeah, and it might be difficult to be able to set up the logistics of that, but you have to do it, right? We get paid to problem solve, and one of the biggest problems that I think people are just kind of throwing their hands up in the air and going, "Well, there's nothing I can do about this." Is, well, the market's throwing me increased costs. How do I mitigate that? It sounds like you guys raise the money on the front end, or are able to borrow it from the bank to at least put it in a warehouse somewhere and store it, and that pretty much eliminates the issue. Also eliminates your supply chain issue. Everybody's complaining that
Right.
they can't get supplies. When you've got that readily available to pull from, not only can you speed your processes up and build it faster, which reduces your market risk, but you've also been able to build it quicker and hit your pro forma better. So you've got a cash flowing asset a whole lot sooner, and that helps things along. Absolutely love it. Now, where do you see construction heading at this current point in time? You've got this very well diversified portfolio. You've got land development. You're doing new construction departments, senior housing. You mentioned something about a storage fund. So it sounds like you're very well diversified. How have you pivoted, and where's your focus now with the changes that have happened this year?
Certainly, construction costs have come down. There's no question about it. Even on the material side, if you think about the price of lumber, peaked last May at $1,450 per thousand board foot. And if you look at the commodity price today, I haven't checked this week, but I'm going to go out on a limb and say it's in around the $450 per thousand board foot range. That's what it was maybe a week ago. So prices have come down substantially. We're seeing elevated prices on things like HVAC. We're seeing prices starting to creep up on windows. Supply timelines are still long. They're still extended for windows, windows and doors in particular. Even the largest national suppliers like Geldwin and Gentech are still seeing long lead times. So that's a long lead item you have to plan for. But the prices are still fairly reasonable. We're still okay with the prices with the larger suppliers.
Mhm.
Where it's becoming a little bit more difficult um, is just those items that are in scarce supply. Some electrical panels, circuit breakers, things like that.
Mhm.
For whatever reason, some of them are in short supply depending on the manufacturer. So sometimes you pivot, you switch from Eaton to another manufacturer, and now all of a sudden you can find supply. So if you're used to working with a particular manufacturer, you got to be a little bit more agile, be willing to substitute components, but do it on a larger scale. Those are the main things that we're seeing in the marketplace. The other thing is on the labor side, folks that thought they had 18 to 24 months worth of contracts locked in are now coming and charging premium prices for you to have the privilege of having them come to your site, are now coming back in a much more humble manner and saying, "What do you have? I may have some availability." It's
It's
what it.
civil engineers and contract. They're starting to answer the phones now. It's interesting.
Yeah, yeah, exactly.
So what steps are you taking to prepare for, the future? A lot of people say we're already in a recession. A lot of people think that, interest rates aren't going to come down or normalize anytime soon. We're going to be in a volatile economic environment. How do you see things playing out in the future, and what steps are you taking to mitigate?
I think unfortunately we're going to be seeing interest rates elevated compared to what they were for at least another year. They might start to come down, but it's going to be at least another year. I think the Fed has no choice at some point to lower interest rates. Everyone, all eyes seem to be on the Fed, and it seems to be dominating the discussion. The inversion in the yield curve suggests that one of two things will happen: either um, either short-term rates will reduce to match the long-term yield, or eventually the long-term yield will have to come up and match the short-term rates. One of those two things. The market is clearly saying they don't believe the Fed. They're literally saying we don't believe you. That and that's why the yield on the 2-year Treasury is 75, 80 basis points higher than the yield on the 10-year Treasury. That's again signaling that the market believes that interest rates will come down in that 24-month time frame. So, it's today, most projects, if you were to re-underwrite them today, what might have looked like a cash out refinance a year ago is going to look like it's debt coverage limited. And you're probably not going to get cash back. You're probably going to have to write a big check to get into your permanent financing out of a bridge loan. So we've had to put a number of projects on hold. Not fun, but we simply were not comfortable taking the risk with investors' money that we would be potentially be in an upside down scenario, converting from a construction loan, from a bridge loan into permanent financing. And we're very conservative in our underwriting. Like we, I see some of the risks that other investors take in the marketplace, and I think they're nuts. I think they're absolutely insane, which spells opportunity. It means a lot of that bridge debt 18, 24 months from now is going to start coming due. Some of it's coming due in the next 6 months, and they'll figure out what to do next. Maybe extend until they can't anymore. And then those distressed properties will maybe partially completed, maybe fully completed, maybe not started, will come on the market at good prices.
Yeah, I think it's going to be interesting to see. A lot of builders, developers I know have basically completely stopped, which means you can bet that 10, 12 months from now, that's going to be inventory that would have hit the market that's not. And that's going to create opportunities in this sharp rise in interest rates that we've had this year, especially to your point with a lot of the bridge debt. That's going to create, I think, a lot of distress in the market, especially the rising construction costs on top of everything. I think you're going to see some fantastic bank-owned properties up for really, really discounted prices here pretty soon. So it's going to make for a really interesting next 10 to 12 months.
Well, I think the other thing to pay attention to as well is the shadow inventory. So what do I mean by that? There's a lot of properties that were acquired specifically, especially in the last 24 months, to put into the short-term rental market. And in my view, that market is oversupplied today. If you go back to 2007, 2008, there were 4 counties that led the nation in distress. We're talking Miami-Dade County, Broward County, Maricopa County, in just out, Phoenix, Scottsdale area, Las Vegas. Those markets led the country in terms of distress, in terms of actual sheer numbers. And why is that? Well, what percentage of those homes were second homes? Would people protect the homestead, or would they protect their second home? They protect the homestead, and they'll let the second home go back to the bank, which is exactly what we saw. If you look at the number, at one point there were 42,000 brand new vacant condos in Miami where the owner walked away. How do you even buy a condo in a building that's a 3% occupancy? I mean, your HOA fees are like, I don't even, how do you do the math? So I think there will be a variant of that where the market is oversupplied in short-term rentals. There's very little impedance to adding a new unit to the inventory of these hotel rooms, so to speak. Just like there's no impedance to adding another Uber driver to the fleet of ride sharing. The impedance is very low. So that market eventually becomes a race to the bottom, where supply continues to grow until everyone's suffering a tolerable level of pain, but no one's making any money. I think a lot of that inventory is going to reappear in the market in the next 12 to 18 months. A very large percentage of the short-term rental inventory was purchased in the last 24 months.
Yeah, it's been easier to get financing. And it seems like we've had this big boom because of all the money printing. It's sort of papered over what the real economic situation is.
Right.
Everybody's got like trillions of dollars in savings set up, and they've just been spending that, which is primarily why you're seeing a lot of this inflation, among other things. What are your thoughts around the people who have bought these short-term rental properties, these second homes, but they've locked in a just record low 2-3% interest rate, long-term fixed debt? I mean, that's one of the reasons why you're seeing a ton of inventory come off the market. And all those people who bought homes at these record low interest rates, almost free money, they don't want to put that on the market. And I think that's why you haven't seen a huge reduction in prices, even though demand's fallen through the floor. The supply has been following with it because no one wants to sell their home. Do you feel like that's going to motivate people to keep these short-term rentals, or do you think the pressure and motivation to still put it on the market because it's not performing as a short-term rental is going to be greater?
Well, I think it depends. If that property can carry itself as a long-term rental and they didn't pay too much and bid too aggressively on it, then that's a good pivot. And I think there will be a bunch that will do that for sure. I've seen lots of reports lately of investors saying, boy, demand just seems to have evaporated. Like from September this year was really strong last year. Where did the demand go?
Mm-hmm.
Instead of getting 250 a night, 300 a night, they're getting $85 a night.
Mm-hmm.
Not a terrible number, but then when you start to factor in the variability and you say, well, shoot, I can average 90 or $100 a night if I do this as a long-term rental without any of the headache and the overhead of managing a short-term rental, maybe that's a better play.
Mm-hmm.
So there's a break point where I think a lot of these will get converted back into long-term rentals as a pivot. And then those that can't, those that were too aggressive, those will end up distressed, I fear.
Yeah, it sounds like that luxury short-term rental market is probably going to experience some distress because you know that most of those are not going to cash flow and probably struggle to get a long-term renter in there.
Well, that's right. It depends. I mean, obviously, it depends on the market. For example, a city like my home city, I live in Ottawa, Canada. If you can, rent that property to an embassy or something like that and get 4 or 5 grand a month from an embassy, probably going to do okay. But if it's a commodity, if it's a luxury product in a commodity market, you're going to struggle.
Mm-hmm. Yeah, I agree 100%. As we go into this new real estate economy, because it's been so hot for so long, and we knew that the merry-go-round was going to come to an event end eventually. What are some of the macro indicators that you're watching, and what are you looking for them to do?
I think it's always important to remember that real estate's hyperlocal and that not everybody's equally affected by the current market conditions. So if you're designing a product, design it for a very specific customer.
Mm-hmm.
I'll give you an example. Let's say, because look, what does inflation do? It does 3 things. It devalues the currency. So it wipes out purchasing power for people on fixed income. It wipes out savings and it wipes out debt. For those that are in that top 2 to 5% of the economic ladder, they're really affected a lot less by inflation.
Mm-hmm.
They have investments that are inflation resistant, like real estate. So that the inflation, that price appreciation, it's not market value appreciation, it's price appreciation because of inflation. We've experienced it for the last 100 years. It goes to the equity holder of the equation. So it's not going to the bank. The bank debt is being devalued. So you want to be always with a bit of leverage, not irresponsible leverage, a bit of leverage. You want to be holding real assets as much as you can. And let's face it, even though interest rates are elevated today, there's still negative real interest rates. If you're borrowing at 5.75 and inflation's at 7.1, it's still a negative real interest rate. Mm-hmm. You're still being offered the opportunity to print money on the arbitrage between those 2 rates. So you want to continue to do that. That's always putting money in your pocket over the long term, even if in the short term, you can't take that extra cash to the grocery store and put food on the table. So that's number one. The other thing I would look at is just looking at the just make sure you don't get over levered. Bring more equity to the table, maintain reserves, sit on dry powder, be ready to execute when these deals present themselves. They will present themselves. And I'm not talking about buying something 10% off. I'm talking about buying things that are deeply discounted, 40, 50, 60% off or more. We've, even in the wake of the 2008 downturn, we bought properties literally for 2 cents on the dollar. And you would say, that just seems impossible, but it's absolutely true. You in difficult market conditions, you can find those opportunities.
Yeah. And I think that you're going to see a lot of distress due to the rising rates, the construction costs, the bridge debt. It's going to open up a ton of opportunities. And to your point, don't be over levered. Make sure you got dry powder, sit on what you can, and make sure that you're underwriting everything really, really conservatively. Victor, this has been a pleasure. If people want to learn more about you or learn more about the investment opportunities that you've got, how do they get in touch?
Well, the company is ystreetcapital.com. It's just the letter Y, streetcapital.com. I also host the Real Estate Espresso podcast. It's a daily show 7 days a week, and would love to have you as a listener. It's on more than 20 different platforms. So wherever you listen to podcasts, you're sure to find the show, and would love to connect with you that way as well.
Go check out his website, ystreetcapital.com, and the Real Estate Espresso podcast. Thanks again, Victor. It was good to see you.
Great to see you. Thank you, Brandon.